Today we're going to talk about converting economic statements. We'll cover it in today's class. We'll cover it in Wednesday's class. In addition, your next graded homework assignment will be the economic statement conversion. So basically what I'll do is I'll give you on Wednesday a series of income statements and balance sheets. You'll have to convert them to the economic statements, which we'll be discussing this week. That'll be due on Monday, 10 a.m. for all sections. 2 weeks from now, we'll have our midterm exam, parts A and B. Part A of the midterm will be convert economic statements, right? So that's the entire part A of the exam. So similar to your upcoming homework, it'll be, here's the income statement and balance sheet. Again, you have an hour and 15 minutes. You'll have to do all the conversions that we're doing this week. So it's a very seminal part of our class. And by the way, when we do the midterm exam part B is, do you understand the rationale for why you did this stuff? Okay, so A is literally just the conversion. B is the theory. Do you understand the theory of what we've been doing this semester so far? All right, and this is a very important part of the semester. I mentioned some of you are probably going to struggle significantly with this week, but we'll do our best to get through it. Right. So to get started, this is a representation of Modigliani-Miller's valuation framework in this infographic. And the idea is that a company's worth the sum of its future cash flows, present value to a today value, discounted for risk. So what we're going to do is, first of all, we're going to take their cash flows and we're going to break them into two boxes or two buckets. We're going to call one of those operating cash flows and the other non-operating cash flows. Right? We're going to value those independently. Right? And what's key is an operating cash flow is the primary cash flow coming from a customer selling our products and services. So it's kind of like the reason why we're in business, right? Versus a non-operating cash flow is going to be something of value, but it's kind of incidental. We don't really need those cash flows to sell more products, but they still have value, right? So again, if you think about a company like Apple, if you saw today, announced they sold 13 million iPhones over the weekend. That's up from 10 million iPhones last year for the same weekend, which is a lot of iPhones for one weekend. But in any event, that's operating. Okay, so they're going to sell a bunch of new phones. It's what they do, has some value. Now, Apple also has a bunch of cash sitting in a checking account somewhere. They don't need that cash to sell all those iPhones. Right? It has value. We're going to call that non-operating. Okay? It's not like we're going to ignore the non-operating value. We're just going to separate a company into operating and non-operating values. We're then going to add the two values together, and that's going to be called enterprise value, or EV for short. Right? And it is that enterprise value which is then available to pay the debt and the equity holders. So debt has the primary claim versus equity. So we're going to take the enterprise value, we're going to pay off all the debt. Whatever's left, the residual, goes to the equity holders, right? Matter of fact, when you read the enterprise DCF chapter, you take equity value divided by shares equals share price. That's enterprise DCF valuation based on Modigliani-Miller, all right? So really what this class is going to be about is how do we take accounting statements and remap and reorganize them to match the Modigliani-Miller format, right? Now, in order to do this, I'm going to give you a mnemonic that I developed a long time ago because I used to teach for a while in McKinsey's analyst training program. And in 2 days, I had to teach them everything that you learned in an entire semester. And what made it even more exciting is almost none of them were business majors. Like they were architectural majors or engineering majors who had never taken accounting. And they had to completely learn valuation, and they had 2 days out of a 5-week program. Right? So I tried to figure out what's the fastest way to teach them some of these concepts, and that's where I came up with Joe's mnemonic. You won't find this in the book. You won't find this anywhere else. It's just something that I've used over the years to help people understand Modigliani-Miller's valuation. So we're going to label each one of those boxes that's on the slide 1, 2, 3, and 4. Operating is going to be called a 1. Non-operating, 2. Debt, 3. Equity, 4. Enterprise value, 1 plus 2 equals 3 plus 4. Operating plus non-operating, 1 plus 2 equals debt and equity values, 3 plus 4. In fact, enterprise DCF valuation, 1 plus 2 minus 3 equals 4. Right? So just a way of helping us think through and reorganizing. It's a process known as labeling when we get to the statements. So continuing on, this is, as I said, what's really unique about this class. It's not really taught in this format almost anywhere else. Because what people typically do, and you'll get this in other classes at Smith, is they'll start with accounting statements, income statements and balance sheets, and you'll directly forecast cash flows. Right? And what I'm going to do is I'm going to give you the intermediate step. Right? So that's what they're talking about in our textbook for McKinsey, is the intermediate step, which is to convert them to economic statements, which is another way of saying that we're going to remap the accounting statements to the economic statements. And the economic statements tie to the Modigliani-Miller model. Right? And I like to look at this as a Lego example. So we're going to take a Lego toy and we're going to rip it apart, and then we're going to put it back together with all the pieces. And what's very important is we can't leave any pieces on the floor. So therefore, when we reorganize the statements, we still have to count for every item that was on those original statements, and we still have to get balancing statements when we reorganize them in the new format. And if we don't, then we've made a mistake. Okay? So let's talk about the reorganization. There's 3 economic statements that we're going to create this semester. Right? The income statement, shown here, is going to be reorganized into a statement of what's called TII, Total Income Available to Investors. The balance sheet is going to be rearranged into something called TFI, Total Funds Available to Investors. Okay, and those will be the first 2 rearrangements. So the way to work is on the income statement, we'll take the operating items off the income statement and we'll put them into that first bucket, box 1, and that's going to get us our NOPLAT. We'll then take the non-operating items off the income statement, we'll rearrange them, and that's going to get us our non-operating income. When we add the 2 together, we get total income available to investors, TII. Then we'll take the debt payments off the income statement, interest expense, and we'll put that in the payments to the debt holders. And then we'll take the equity items off the income statement, net income, and we'll put that into the equity bucket. Okay? And what we'll get is a balancing statement of TII. We'll do the same thing with the balance sheet. Okay? So we'll take all of the operating items off the balance sheet, we'll net them together, and that's going to be called invested capital. We'll take the non-operating items off the balance sheet, we'll net those together, that'll be the non-operating assets. We'll add those 2 together, TFI. That'll equal the debt on the balance sheet, the interest-bearing debt, and the equity items on the balance sheet. So TFI, 1 plus 2, will equal 3 plus 4. Okay, that'll be the rearranged balance sheet. Now, when we do the rearranging, it doesn't matter whether we rearrange the income statement or the balance sheet first. We can do it in either order. Doesn't matter. However, to get to statement number 3, which is the cash flow statement, which is called the CFI, cash flow available to investors, you would have needed to do the income statement and balance sheet first. You need a TII, you need a TFI in order to create CFI. Okay? So the cash flow statement is what we're eventually trying to get to. And the cash flow statement, following the 4-box framework, will be applying this process. Cash flow is cash flow from the income statement minus the change in the balance sheet. So we're going to take that process and we're going to go through it 4 times. So, what is free cash flow, which is the operating bucket? It's going to be the NOPLAT minus the change in invested capital. That's free cash flow. Right? What's the non-operating cash flow? It's going to be the non-operating income minus the change in the non-operating assets. Non-operating cash flow. When we add those 2 together, cash flow available to investors, CFI. And what's that going to equal to? It's going to equal to the debt payments off the income statement minus the change in debt in the balance sheet. That's the cash flow to the debt holders. It's going to be the dividends to the shareholders, change in equity, either increase or decrease stock of the balance sheet. That'll be the cash flow available to the equity holders. We're then going to take this cash flow statement, we're going to forecast it, and that's going to be our valuation. The forecasted free cash flows, operating value. The forecasted non-operating cash flows, non-operating value. The sum of the 2, enterprise value. Another way of looking at this, if we forecasted CFI, we could directly forecast enterprise value. Okay, that's the nice symmetry of the statements that we're actually creating. And that'll equal to the forecast of the debt cash flows, which will be the debt value, and the forecast of the equity cash flows, which will be the equity value. So again, 1 plus 2 will equal 3 plus 4. That's the process that we're going to go through. General questions about this? This is the kind of concept behind what we're doing. Because as I said, this will help you as you get lost in the trees. Right? Because in the trees, we're going to be moving a lot of stuff around, but this is the goal of what we're really trying to do. 2 advantages to this process. Advantage number 1, as I said before, it makes the analysis very clean. So for example, one of the key terms is ROIC. What is ROIC? It's no plat divided by invested capital. We would have defined no plat, we would have defined invested capital, real easy to calculate ROIC. What is another key item? Free cash flow. We'll have a direct calculation of the free cash flow for the companies that we're going to forecast. So by rearranging them, it makes for very clean statements to forecast for the business. Right? Number 2, the idea of balancing. So these statements, when we rearrange them, will balance. That will have an operating side and it will have a funds flow side. And the 2 sides of those statements will always balance. And you're going to hate this because when you're learning how to do these statements, you'll probably have unbalanced statements and you won't know why. But that's important because an unbalanced statement is an error. All right? So I actually had a former student who emailed me this morning, and she's using the model we've developed in this class, and she said she can't get her CFI to balance. All right? So she knows that using real companies' cash flows, that she has an incorrect cash flow valuation because something is wrong with her forecast of cash flows. By using this approach, she knew she made a mistake. If she didn't use this approach, she wouldn't have known to make this mistake. And here's what I mean. For most ways that you're taught to calculate free cash flow, you calculate free cash flow, but then you stop and you're done. Right? So if you left something out, you have no idea that you left something out. You just made a mistake. If I force you to balance where the free cash flow went, and you show me that it equals the free cash flow you generated, you're less likely to make a mistake, and you're less likely to leave something out. And that's what my former student had noticed, is she noticed that the free cash flow was not balancing with the funds flow of where the money went, so she knew something was missing. And I'm telling you, most people skip that step, and they just create these cash flows. And, most of the time you're right, but when you're wrong, you have no idea you're wrong, and then you just look bad later. So by going through this process, which you'll hate, right, it will actually make you better at what you do, and it'll make your valuations cleaner and less susceptible to mistakes. Okay? So that's the process that we're going to go through, and that's what we're going to start with this class today. All right? Got questions about any of this? All right. The other thing, and we started to cover this a couple weeks ago, is this is a slightly different version than what you would have learned in other classes, what's actually used in the real world, and what's in Bloomberg. And this has to do with the custom fields that I had you create. Right? So, and I'll give you an example of this by going with the Modigliani-Miller approach. So on this slide are 2 views of ROIC. On the left is what people use in the real world. On the left is what most finance classes teach you. On the right is the operating ROIC view that we're going to use in this class. Right? So the point is, I'm not saying that people are necessarily wrong in their approach, but what I'm saying is the world has gotten more sophisticated. So as I mentioned to previous classes, like I went to Wharton, I sat on the other side of the table, I had to learn this stuff in the late 80s. Right? And the original textbooks, like we had Brealey and Myers, and then there was Ross and Westerfield, and then, I don't even know, recently when I've been teaching it to the MBAs here at Maryland, it's Burke and DeMarzo. But I'm telling you, 2 of the seminal textbooks, the original one, Brealey and Myers, were written based on what happened in Chicago in the 1970s, and those were the original textbooks written in corporate finance that were taught in the 80s at the top schools, which are in whatever their 7th or 8th or 9th edition now, but basically those are the textbooks that are used in modern corporate finance today. You probably took them in your previous classes. And back in the 80s, it really was a simpler time for corporate finance, right? We didn't have the crazy tax structures that we do today. We didn't have the international joint ventures that we had today at the scale that we do. We didn't have companies like Apple and Google with hordes of cash just sitting in Ireland, unpaid out, excess cash, huge cash balances. That really didn't exist back in the early 1980s. So the point is, when they did the original formulas, which by the way, Bloomberg was created in 1981, and so the original formulas came out of these original textbooks that have been in the banking industry ever since. When people learned this, financial statements were much simpler. So, saying that, and look at invested capital, was defined as interest-bearing debt and equity, and I look at the return in my debt and equity equals, because balance sheets have to balance, primarily the return on all of my assets, right? And since I didn't have a lot of non-operating stuff back in the 80s, then I didn't really worry about the non-operating stuff, and I could actually make some simplifications to say that would equal the return on my assets. But here's the thing. Let's think about Apple. Apple, which sold 13 million iPhones over the weekend, which is, again, pretty good at $750 a phone, do the math. It's a lot of money. But here's the point. Apple doesn't need almost $200 billion worth of cash to sell 13 million iPhones, right? Apple's got a huge amount of cash hoard because they're keeping it, again, outside the U.S. to avoid paying U.S. taxes. So basically, if we use the traditional definition of ROIC, the key to operating assets is to sell the next iPhone, how much money do I have to spend on the balance sheet? Well, if I use the definition traditionally of ROIC, then I need to go borrow another $200 billion worth of cash to sell another 13 million iPhones. Well, that's nonsensical. They don't need to do that. They're generating so much cash, they don't need any cash. So that's the problem with the traditional definition of ROIC. So what Modigliani Miller says is no, take the cash out, value it separately, and look at the operating stuff that's actually involved. And I'll give you an example of this. You can see this in Bloomberg today with your custom fields for your homework. If I go to Bloomberg and I go to Apple, this is an example, and I go to the RV section, right? And I go to the custom screen, I could look at, and we did this with the operating spread for our homework assignment. This is the traditional definition of ROIC. Apple's ROIC is 24%. That's the return on their assets primarily. That's the return on their debt and equity. Well, here's the thing. If you take out their cash, which is mostly non-operating, the actual return on what they use to actually produce iPhones and iPads and computers is 255%. Okay? So that's the difference between the Modigliani-Miller approach on the right and the traditional approach on the left. Okay? So that's the point. Apple's making 255% when they sell iPhones, iPads, and computers. They're making like 1 or 2% when they put money in the bank and just earn it on cash. The weighted average for both works out to the, whatever number it is, 24%, right? But if I'm really thinking about how well they did this weekend, they're making 255% on 13 million phones. They're not making 24% on 13 million phones. So I'm going to misvalue Apple in the future if I assume they have to reborrow all of the cash. All right? So that's practically why we're going through this method when we do the valuation. It will make you better at your valuations. Right? Now, here's the other thing. Don't go to your other professors and tell them that they're wrong in their approach. Right? They'll fail you for insubordination. Right? So what I'm telling you is that people may take shortcuts. People may do it in other ways. And by the end of the semester, you will know that they've taken a shortcut. You will know that they're following a convention. And you'll know why they're following that convention. But that's what's key, and that's what I want you to understand by going through this process. All right? So let's go back to this. So what we'll do is we'll say, okay, Assets are going to be broken down to operating and non-operating. So we have my operating assets, we have my non-operating assets. We'll look at the return in the operating assets, we'll look at the return in the non-operating assets separately. Then we'll look at the cash flow to the debt and the equity, or the amount of debt and equity that finances it. So when you see ROIC in Bloomberg, it's the return on the debt and equity. When you see the custom field that you did for your last homework assignment for operating ROIC, it's the return on the operating assets net of the operating liabilities. Right? What's different is it takes out the non-operating stuff. So by definition, our operating ROIC will always be higher or lower than the Bloomberg ROIC. What's the answer to that question? Will ours be higher or will ours be lower? This is an example of Part B of the midterm, by the way. Will operating ROIC be higher or lower than traditional ROIC?
It will be higher if they have a positive spread.
Yep, because basically we're taking out the non-operating assets. So that's why it would be higher. Okay, everybody see that? Okay. All right, so let's get on to conversions. So using the example they have in the textbook, I pulled this right out of the textbook. Let's start with a very simple balance sheet. So this is the spreadsheet that I told you to download as part of this class. So assuming you downloaded the spreadsheet, this is the spreadsheet where I just retyped the numbers. You're welcome to type them up yourself if you want. But these are the numbers that came right out of the book. What I've added, something called labels. And I strongly recommend that you follow this labeling process first because it will lead to less mistakes over time, particularly when you're learning how to do this stuff. It's easy to make mistakes because on your midterm, you're going to probably have 30 to 35 items to convert as opposed to this very simple statement, which has 6. Right? So the statements are going to get far more complicated very quickly. Okay? So labeling will help you start to keep stuff straight. So the way the labeling works, again, going back to the mnemonics, if it's operating, it's a 1. If it's non-operating, it's a 2. If it's interest-bearing debt, it's 3. And if it's equity, it's 4. Okay? So let's start out with cash. 1, 2, 3, or 4. Listening for a number? Okay. So cash is a trick. In the simple example in the book, we're going to call it a 1. But the actual answer is cash can be a 1 or a 2. Right? And what we're going to start defining is the difference between what's called operating cash and excess cash. Operating cash is the cash that's actually used to run in the business day to day that can't be paid out. It's the lifeblood of the business. Excess cash is the cash that can be paid out because it's not necessarily tied up in the business. Right? So let me give you an example of a misnomer shortcut. You guys heard of something called net debt? Somebody know what the definition of net debt is? Yeah.
Total debt minus cash.
All right, so total debt minus the cash on the books. It's called net debt. I'm just repeating it because this is on video. Here's the problem with net debt. It's a fallacy. A company could never take all of its cash and pay it to the debt holders. It just wouldn't happen. Because let's say the company went bankrupt, right? Who gets paid first in a bankruptcy? Not the bondholders. Very first people to get paid in a bankruptcy. You go to a judge, the judge approves payments to these people first, and they're protected above all else. Anybody know? It's first on the list. Even above the creditors. It's the lawyers. So I'm just saying, we have a legal system that protects its own. So if a company goes under, the lawyers get first dibs. Then you're going to get the IRS, the tax holders. You're going to get some employees that are going to get paid. So even if you're a secured bondholder, you're not going to get all of that cash that the company has. So that's what I'm saying by shortcut. We say net debt's a shortcut, but practically it's not what actually gets paid out. What gets paid out, a better definition, would be excess cash. Like take that cash that can't get paid out to them, and what's left is the real net debt of the business. All right, but that's not the definition that's used on Wall Street. So that's what I mean by it's not saying Wall Street's wrong. What I want you to understand is that Wall Street's using an implied shortcut. Theoretically, it makes sense, but it is a shortcut. Okay, so let's go back to this. here's how I learned this years ago. I've been using this example for a while of understanding the difference between cash and excess cash, operating in excess, which is when I was 15 years old, my first job was working at Burger King. And I worked drive-through. I made $3.35 an hour back in 1984. Okay, I was in the Burger King drive-through. And so basically what happened is I would go into my shift and I'd go to the back of the Burger King, and I'd be in there with the manager, assistant manager, and they'd pull a cash register till out of the safe. And the money had either, I don't remember the exact amount, but it was either $80 or $120. All right, let's say the number was $120. Okay, so it was $120 in the cash register. Now, in 1984, people weren't paying in the drive-through credit cards. It was pretty much a cash business. So we would count out the $120 in the register in front of me to make sure that there really was $120 in there. He then, with me, walked the register to the drive-through. He'd take the register out of the drive-through till that was in there. He'd put my till in there. He'd reset the register to say there's a new register till in there. And then I'd do my shift. At the end of the shift, he'd come in. He'd swap out me with somebody else. He'd take that cash till and he'd get again, flip a switch to say it had been switched. It would give him a printout, by the way, of all my transactions. We would go back to the register back to the till to his office. He would count out the $120. He'd take everything above $120 and he'd put it outside the register, okay, outside the till. So you always leave $120 in the till and they take out the rest, right? And that would be used for the next person that was going to use that till on their shift. And that was the point. That's operating cash. See, Burger King or any fast food restaurant needs to have some cash to make change, right? Otherwise, they can't function. Even today, it's not 100% credit cards. So that's what I mean by operating cash. I can't use that to pay salaries. I can't use that to buy capital expenditures. I can't pay a dividend with that cash. It could never leave the business. Otherwise, the business wouldn't function. So that's the idea of operating cash, right? So businesses have a certain amount of operating cash. So for example, when General Motors went bankrupt a couple of years ago, they actually said this. And people probably read this article in the Wall Street Journal and thought that they were just, crazy. But they basically said, when we go below $10 billion of cash worldwide, we will have to go bankrupt because we will cease to function, right? And people probably read that article and this doesn't make any sense. Are they just a bunch of greedy bastards? And the answer is no. When you're a $160 billion global company with subsidiaries in all these countries, moving cash around the world is not as easy as you think it is from subsidiary to subsidiary. And making payroll starts to get hard and paying suppliers gets hard, and that's the problem. Same thing, I work with a lot of hospitals. Hospitals are somewhere between 20 and 25 days. If hospitals have less than 20 to 25 days of cash, they cease to function. So it's not zero cash. It's a certain amount of cash that they actually need, otherwise they will shut down. So that's operating cash. And so when we go through companies, we are going to have to distinguish what is their operating cash and what is excess cash. Operating cash is a 1, excess cash is a 2. Okay? Same thing for Apple. Apple doesn't need $200 billion to run Apple. They need some amount of money to run Apple. That's going to be their operating cash. For Apple, it might be $1 billion, $2 billion. Everything else is excess. We have to separate that out. Right? For this simple example, the way they did in the book, they're just going to call this operating. Later, particularly on your homework assignment, you're going to see excess. That means a 2. Okay? Operating excess. I'll tell you it's operating or excess for the homework assignments, but later in the semester, it'll be something we'll have to determine for the companies that we value. Questions about that? Does that make sense? All right. Label. Inventory. 1, 2, 3, or 4. Operating 1, non-operating 2. What's inventory? 1. Net property, plant, equipment. 1, 2, 3, or 4. Okay, why?
Because you need to operate the business.
Yeah, the net PP&E is going to primarily be our manufacturing facilities that we're going to operate our business on. Okay, so we're going to make our products or service in there. Hence, net PP&E is traditionally operating. Okay. What about equity investments? We own a stake in another business that we don't actually manage. I'm Yahoo, and I own whatever it is, 20 or 30% of Alibaba. Equity investment. Yep. Yeah, it's non-operating, so we'll call this a 2. That would be an example of a 2. Accounts payable. We have 1 operating, 2 non-operating, 3 debt, 4 equity. Yep. Yeah, accounts payable, even though it's a liability, is considered an operating liability because it's funding primarily our inventory and our day-to-day operations. And the key between an operating liability or non-operating liability and debt is something with interest attached to it. So if there's an interest rate attached to it, it's debt. If there's not an interest rate attached to it, it's going to be either a 1 or a 2 as a liability. Okay? Now it gets tricky, right? Because one could argue that if you don't pay your accounts payable, eventually people are going to charge you penalties, right? But technically, we're going to consider that a non-interest-bearing liability, okay? Because you do have a period of time where you could pay for free. Whereas if you have a bank loan or if you have a bond, you're paying interest on holding the money out. So that's a 3. Okay? All right. Interest-bearing debt.
3.
There we go. Retained earnings.
4.
4. That's your equity. Okay? So that's what I mean by labeling. All right. Now, what I'll then recommend is when we create these economic statements in Excel, you create 1 tab per statement rather than trying to put them all in this tab. So what I would do is I'd come down here to the plus, I'd create a new tab, make it bigger, easier to see. So this is my TFI. So we're going to start with TFI. And the metaphor is in the book, statement on the left becomes the TFI statement on the right. Okay, so this is the one we're going to reorganize. All right. So the other advantage of doing new tabs is a little bit of copy and pasting. So here I'll take my prior year, current year label, copy this over. And now I want to go through Bedigliani-Miller. So Bedigliani-Miller, I want to take all my operating items and I want to put them together and I want to net them against each other. So I want all my 1s together. So I look for anything that's operating, anything labeled as a 1, and I put it together. So I'll start out with cash. And then my next item is my inventory. My Excel's got like a ghost in it today, and I don't know why. So I'm just going to copy these down. All right, those are my 3 1s off of my balance sheet that are assets. Now I want to net these against any liabilities that are 1s. So I do have a liability 1, which is called accounts payable. I'll put that on here as well. That, when I net it, gets me something called invested capital, also known as operating invested capital. All right, what is it? It's my assets. Add the 3 together, cash, inventory, net PP&E, minus my liabilities, accounts payable. That's my operating invested capital. In fact, I'll even put the word in here, operating, in front of invested capital. So 380 and 440. Everybody see what I did? And here's the nice thing about the labelings. If you put the labels on the statements and you carry the labels forward, notice how all your 1s are together. This is what I mean by not leaving Legos on the floor. Because what's going to be a source of frustration for you as you do this yourselves with the homework assignments and the midterm exam is you're going to have a bunch of items on there, and if you forget one of the items, your statements will never balance and you'll get really frustrated. Or you'll put the item in the wrong bucket. You'll put a 2 in with the 1s. So you'll get a balancing statement, but you'll have the wrong invested capital because you've mixed up non-operating and operating things together. So by carrying the labels forward, it's less likely to happen. Okay? I'm not saying it's not impossible, but it's much less likely to happen that I'm not going to put a 2 in my 1s and realize that I mixed my operating and non-operating together, because what it'll mean is I'll get the wrong invested capital. Okay? All right. So next, I do look for my 2s. What are my non-operating assets? Well, there, it's my equity investments. And then I look to see, do I have any non-operating liabilities? Now, right now, I don't have any non-operating liabilities. Right? If I did, which you will on your homework assignment, I would net those out just like I netted out accounts payable. Okay, so come back here to TFI. TFI, total funds available to investors, is my operating plus my non-operating. So therefore, it's my invested capital plus my equity investments, 395 and 465. Got my ones and my twos. Now, this is what I mean by balancing statements. That has to equal the debt and equity financing. I then go to my threes, my interest-bearing debt, and any fours, which are equity. I add my threes and fours together, and if I did it right, this is what I mean by balancing statements. My statements balance. 395 on the asset side, 395 on what's called the funds flow or financing side. Right? Here is an incorrect answer. Let's just say, for whatever reason, I forgot to put the debt on my statements. So my two sides of my statement don't balance. One of them is actually the correct answer. I just forgot to put debt on one side of the statement. And let's just say that I answer on my assignment for a grade 395, which is the right answer. But I show in my show my work section that I can't get the statement to balance. That's a 0 in this class. You don't get credit because you had a 50-50 chance of being right. Well, that's not a good way of answering a question that you just got lucky. Right? I want you guys to be good. So that's the point. I don't know what the right answer is. I can only guess which of these two sides I think the right answer might be. So the only way that I know that I have the right answer is if I actually say 395 and I can show you that the statements balance. So that's what I mean by balancing statements. All of the economic statements will be reconciled where the ones and twos equals the threes and the fours. So not only must you have the correct answer, you must show a correct reconciliation to get full credit on your assignments. Right? And that's what I'm telling you. You're not taught to do that anywhere else. Right? Anywhere else, when you calculate invested capital, you stop at invested capital. And you don't do the rest of the statement. Right? And I'm just telling you, every now and then, you just forget something. You're human. And you don't know that you forgot it. And that's where I mean you get prone to mistakes. I'm not saying you can't make mistakes balancing it, but you're far less likely to make mistakes when you balance it because you have to account for every item on a balance sheet, and the balance sheet won't balance when you rearrange it if you forget something. Okay? So it's less likely to make mistakes. So it sounds great in theory. You're going to hate me for the next 2 weeks. I just accept that because you're going to get really frustrated with a statement that you're going to have not balanced and you don't know why. Right? By the way, in the midterm exam, you're going to do all three of these statements, 3 years, about 40 items. You have an hour and 15 minutes. So you got 2 weeks to get good at this. Okay? Then the rest of the semester gets really fun because we do this for real companies. And that's where it gets hard. Because then companies with accounting statements create these categories you have no idea what they are. And you got to figure out, is this operating? Is this non-operating? Is this some combination of both? What the hell's in this other asset category? That's just this ubiquitous number. And it's really big. So it's kind of important as to which side of the category we put it into. Anyways, that's for later. Questions about TFI? Statement number 2, TII. I'm going to create a new tab, and I'll call it TII. Then make it a little bit bigger, easier to see. Same process. Copy over my labels. Keep the column synced up so it's easy to copy and paste. Same process. We have an income statement. It's down here on the data tab. We want to label all of the items. So we'll start with revenue. 1, 2, 3, or 4. Mapping to Bigliani Miller. Do we think it's operating or non-operating? Typically, it should be operating, so we'll call that a 1. Operating costs. Well, that's pretty obvious. Depreciation. Yep.
I would say it's connected to the fact that you did an investment in the past. It's basically
So you say it's operating.
I wouldn't say it.
Oh, it actually is operating. Yeah. So depreciation is operating. So let me give you two rules of thumb, which you did touch on, which is the items that are expensed on the income statement that come from items on the balance sheet should have the same label. Meaning if it's operating on the balance sheet, it should be operating on the income statement. So depreciation comes from net PP&E. And the whole idea of depreciation is I'm expensing a plant where I'm making a product that I'm selling to a customer. Well, that's operating. So therefore, the depreciation is an operating expense that's coming from the operating net PP&E assets, which is where I'm making my products and services. So it can also help you to think about the consistency of the item on the income statement versus the balance sheet. So depreciation is operating. Operating profit is the net of the three items above them, so we'll skip that as an intermediate category. What about interest expense? What cash flow is that going to? Yeah.
So by your logic, it shouldn't be operating because it's part of the balance sheet item that is debt.
So what would it be? But what number would it be? 1, 2, 3, or 4? So 1 and 2 are operating, non-operating. 3 is debt. 4 is equity. So yeah, exactly. So we would qualify the interest expense as a debt cash flow and it would be labeled a 3. Now, here's where we would diverge. I'll give you an example from the way that traditional people make shortcuts. What if you had interest income? I know it's not here, but what if you had interest income? So I have excess cash sitting at a bank somewhere and I get some interest income on it. Not much, but I get a little bit. What would that be?
2.
Yeah, that'd be a 2. Right? Because that's the point. I have excess cash, which is a non-operating investment, generating non-operating income, interest income. See, a lot of finance people will tell you to look at net interest expense, right? But what they're really doing is they're mixing operating and non-operating together, right? And I'm not saying that you can't do that, but I just want you to know that if somebody were actually to look at net interest expense, that's what you'd be looking at for a company. You'd be looking at a mixing of those two numbers, right? So it just makes it a little bit less clean when you do a valuation, because what you've done is you've taken a non-operating cash flow and a debt cash flow and you put them together. Now, when the primary valuation is based on free cash flow, probably doesn't make that big a difference to your valuation, but nonetheless, that's what they're doing. Right? So that's what I'm saying. I don't want you to go to people and say you're wrong doing it this way, but I want you to understand when they ask you to do it this way, that that's actually what they're conceptually doing. Right? As at least it goes back to the Modigliani-Miller model. Okay? So we will make shortcuts, but when we take a shortcut, I want you to understand the rationale for why the cash flow is where it is. Okay? So back to this. Interest expense is a 3. Equity income.
4.
Right? That would be an equity cash flow. Where did the equity income come from? On the balance sheet. On this balance sheet, where did the equity income come from? It came from the equity investment. What do we call the equity investment? Non-operating. So the equity income, 2. So that's the point. Yahoo owns a piece of Alibaba. Alibaba makes some profits. They give Yahoo a piece of those profits. That's non-operating, right? So from Yahoo's perspective, it's non-operating, right? From Alibaba's perspective, it's income, which is equity, which they're paying out. But from Yahoo's perspective, it's a non-operating investment that I generated non-operating income on because it's on the asset side. That's what I mean by accounting. You got to remember your accounting. Okay? So to be honest with you, if you got accounting people in your groups, please leverage them. They should help you with some of this stuff if you're not an accountant. Tax. One, two, three, or 4. Got very quiet in this room. All right, I'll save you. I'll save you from yourself. Go ahead.
Maybe I'm wrong, but I'm the only one.
That's okay. I appreciate your willingness to, because that's how you're going to learn. It's okay.
It's something that is a product of what you are doing because you have to pay tax when you operate, so it's the same.
It is operating. It's also non-operating. And it's also debt. So you're absolutely right. The tax is something that you do as a function when you're operating. You pay taxes on that. Tax is also something that you would do as a function of non-operating. You pay taxes on that. And tax is the shield you get when you sell debt. So that's the point. Tax is a little tricky because what we're going to do is we're going to spread the tax impacts out. Now, we're still going to pay the same amount of tax that the company pays. We're just going to put it into the right bucket. Just like cash. We're still going to end up with the same amount of cash the company reports. We're just going to call some of it operating and some of it excess. But it's going to still add up to the total amount of cash the company has. So this is part of the rearranging we're going to do. So this one was a little bit tricky. Okay? So technically, by guessing one of them, you did have it right. Just more right would be 1, 2, and 3. Net income. Who gets the net income?
Probably I guess it's similar to the tax that we pay, because when you look at the things that make up net income, it's not just 1, it's also 2 and 3. So I guess it's 1, 2, and 3.
Okay, yeah.
Or it's for equity holders.
Yeah, because eventually the 1, 2s, and 3s have already been distributed. So equity is the residual that goes to the shareholders. So it actually is a 4. So equity is a 4. Right? And here's the final one that's a little tricky. Common dividends is a 4. It's an equity cash flow. However, for purposes of TII, total income available to investors, since it's a rearranged income statement, common dividends are not part of net income. So when you do TII, you actually stop at net income. Okay? So that'll be very important. Right? So if you tried to balance the statement with dividends, it won't balance. Now, when we get to the cash flow statement, we'll need the dividends for the cash flow, CFI. Right? But for purposes of TII, we actually stop with net income or net profit. Format of the statement. So, back to TII. We've done our labeling. Let's now create our statement. The first item we want to do, back to the process, we can go back to and see Q, is we want to take all of our operating items and we want to create our NOPLAT. Now again, I don't like taking too many shortcuts at this point in the semester, but here's one that I will let you take. Is if you look at the TII, NOPLAT is our operating profit after tax. And if I look at my operating profit, everything above operating profit is a 1. So rather than creating 3 line items, we'll just start with operating profit, which by definition is operating. Okay? So equals operating profit. And I'll call that my 1s. Now, here's what I meant by the tax issue. So if we reported tax on operating profit, and in the PowerPoint slide, down here, there was a little footnote, and the footnote, it said tax rate, marginal tax rate of 25% on all income. All right, so our effective tax rate is 25%. So what would happen is we would pay minus that times 0.25. We would pay 70 in taxes if we reported just 280 in net income, in operating income, operating profit, assuming a 25% tax rate. So a quarter of that would go to taxes. And that would then get us our NOPLAT, also known as NOPAT, which is the operating profit minus the taxes. That's the NOPLAT. Now again, as you get more familiar with the statements, you'll do NOPLAT equals operating profit times 0.75, 1 minus the tax rate. But I think it's helpful to write out mechanically what's happening here so you understand the way the cash flows are working. So that's what I mean by the taxes are a little bit different. In the operating section, I made 280 of profit. I pay 25% of 280. I pay 70 in taxes. Now, eventually, the company paid 66 in taxes, and I have to reconcile to the 66. Right? But right now, I'm at 70. So we're going to keep moving those tax impacts around. Questions about what we did here? All right, non-operating. I look for any 2s on the income statement. So I go down here, and I had 1, 2, and it was this line item, which I don't know why it's doing that, equals equity income. Real ghost in my Excel. Ghost 5 or something. Anyways, I make $4 million of equity income. So I am going to have to pay tax on equity income at a rate of 25%. So my taxes are the $4 million times the 0.25. I'll pay $1 million in taxes. So my after-tax equity income is 3. Now, in the book, they do it in some weird, bizarre way that I don't understand. I actually think they made a mistake. Right? And fortunately, I know one of the authors, David Wessels, and I know another author, Mike Giachello, who's writing the workbook. And I'm going to be talking to them this week and figuring out, because I think they actually made a mistake. I think whoever edited this section made a mistake. Right? Because in the first 5 versions of the book, they did it a different way. And when I was involved with McKinsey a decade ago, they did it a different way. In this book, they're doing it this way, which doesn't make sense. And there's no explanation in the readings for why they're doing it this way. So I think that the guy that did it, or woman, whoever it is, made a mistake. Right? But I don't know. I'm going to vet that with McKinsey. But so let me tell you the way that I think it should be done, and then you can tell me why you think I'm right or why I could be wrong, because this is an example of Part B of the midterm. So whether or not this is a mistake would be a really good essay question for Part B of the midterm. So let me finish this. We'll come back and ask that question. So here's what should happen. All right, that's my 2. So then I have my total income available to investors, which are my 1s plus my 2s, which is that plus that, which is 213. That's my TII. Okay. Now, I then go to my 3s. What are my 3s? Well, my 3s are my interest expense, and my interest expense is my 3. Now, this is again something that will confuse you, but on this statement, interest expense will show up as a positive 20, not a negative 20. Right? And this is where you have to throw out your accounting bias, because this is not based on accounting. This is based on economic cash flows. So here's the idea of the statement, because this also plays through to the CFI. I make $213 million of income. I need to balance where the $213 million went. I have positive profits. I have positive payouts. Payouts are positive numbers because that's the only way the statement's going to balance. Right? Because if I have a positive income and I have a negative payout, my statement will not balance. The only way my statement's going to balance is if I sync up the signs. So the format of the statement, total income available to investors, is I have profits, I then pay out my profits, they're both positive numbers. Right? So the interest expense is a payout to the shareholder, or payout to the debt holder, and therefore it's a $20 million positive payout, which comes from the $213 million of income that I have available to pay out. And that's how I'm going to reconcile my 2 statements. All right? Now, continuing on, I will have a tax shield on the interest expense. All right? The IRS will let me deduct the $20 million as a cost of doing business. So my tax shield will be this $20 million times 0.25%. So I'm going to save $5 million in taxes, which is also a 3. So my after-tax interest expense is 15. Okay, so I pay $20 million of interest, but the IRS lets me deduct 5. like the home mortgage deduction. Corporations can deduct interest expense as a cost of doing business. At a 25% marginal rate, I essentially save $5 in taxes. So I'm paying $15 in interest. Finally, net income. If I go here, net income is my 4. It's already a positive number. I add my 3s and 4s, my interest expense and my net income. 213 matches 213. Balancing statement. Follow the tax logic. How much tax did the company originally pay? What's the number?
66.
So we still have to add up to 66 in taxes. Let's vet that. How much tax do we pay for operating profits?
70.
How much tax do we pay for non-operating profits?
1.
70 plus 1 is 71. We got that? How much tax shield did we get by having debt?
5.
What's 71 minus 5?
66.
We end up with the same taxes. Everybody see that? But what we've done, again, mapping Modigliani-Miller, is we've mapped it to the area that the tax impacts. So that's the point. I have debt, I have interest, I save taxes on the interest, I have a tax shield on my interest. I have equity investments, I have profit on the equity investments, I have the tax that I pay on those equity investments, non-operating. I have operating profit, which comes from selling my stuff using the receivables, payables, inventory, net PP&E. That created the operating profit. I pay operating taxes on the operating profit. That's my operating taxes. But they're eventually going to net to the overall taxes when I mush the 1, 2s, and 3s together, which is what a traditional income statement does. We're just disaggregating, but we still got to get to the same totals as originally reported. We can't come up with a different amount of tax than what the company actually paid, because if we do, our cash flows won't sync. We're just putting them in the correct areas. Does everybody see what we're doing? Does that make sense? All right, here's the advanced question. Look at this slide, which is right out of the book. What's the problem here? Or what's the potential problem here? What did they do, and why does Joe think they made a mistake? And maybe there's just some sort of new thinking in McKinsey, but I couldn't figure it out from the book, and I actually think it's a mistake. But I don't know. Tell me what you think. Do you agree, not disagree? As I said, this would be a perfect essay question for part 2 of the midterm. It has to do with the taxes. Give you a hint. What's the challenge with the taxes in the way they did it on this slide?
They're showing non-operating taxes as a positive deduction, and then they're not.
Well, they're showing it as $4 million.
Yeah, they're showing it. Yeah, they're showing it as 4 when it should only be 1.
Well, how do you think they got 4? Yeah.
Combine the tax shield on interest expense with the non-operating.
That's exactly what they did. They've combined the tax shield, the interest expense, the 5 savings, with the dollar of sort of taxes that was paid in the non-operating, and that's where they got the 4. Okay? And then the statement's balanced. Right? So it makes sense that the statement would balance, and that's at least how they got to the 4, because I'm telling you, just reading through the book, it was not obvious how they got to the 4 if you didn't really understand what was going on with these statements. Right? So that was the first thing. But here's the second thing. Why would I question that that could be a potential mistake? Why do I not agree with what they did? Yeah.
Cash flows don't line up. You're trying to say that, like
What cash flow is not lining up?
the shareholders.
The tax shield on the debt. That's the problem, is they're taking a 3, they're taking the tax shield on the debt, and they're calling it non-operating. So I have debt, which is a 3. I have interest expense, which is a 3. I have a tax shield, which is a 2. I have non-operating investment on the balance sheet. I have non-operating income. I have non-operating taxes. For 5 editions of the book, 3 became 3 became 3. In this edition, 3 became 3 became 2. So, and there's no explanation in the book of why they made that change. Because I'll just tell you this, and that's why I put the old TII in, this was the 5th edition, which was the 4th edition, which was the 3rd edition, which was the 2nd edition, which was the 1st edition, which is the way that I was taught to teach the McKinsey people a long time ago in the ATP, the actual statements. So unless something's fundamentally changed about their thinking, this just doesn't ring true to me the way that Modigliani-Miller was originally mapped, right? So that's what I'm saying. I at least know why they did what they did, because I know that they're mixing the tax shields on the debt with the tax cost of the equity for the equity income, right? But that's the point. Is by the end of the semester, when a company does something like this, you'll at least know what they're doing. Whether you agree with it or not, you'll at least mechanically know why they did what they did, right? And whether they're making a shortcut or whether they're thinking about it in a different way. But that's an example of how it would be confusing. And by the way, if you had to recreate this without sort of the knowledge of the process I gave, it would be really hard to do, because what you'd have to do is you'd have to do it one way on the balance sheet, you have to do it a different way on the income statement, and that's how you're going to get it to balance, which I find to be confusing. So that's why, to be honest with you, I think they made a mistake. I think whoever did this edit made a mistake, and it wasn't caught. Because, and this is key, statements still balance. And so this is an example of how you can actually have a balancing statements with a potentially incorrect answer, right? Because they classified something in the wrong box. They classified a 3 as a 2. And I'm just telling you, it happens a lot, right? And that's what I'm saying. You can make this mistake, not even realize you make this mistake, and it could be a mistake. Or maybe they really are classifying us as 3 as a 2, but it doesn't make 100% sense to me, because what they're saying is a tax shield, which is a debt cash flow, is being moved into a non-operating cash flow. Right? And so that's why I'm questioning the logic of what they do. Right? So by the end of the semester, as you understand Modigliani-Miller, that's what should be really clear to you when companies do these things. Right? And or at least ask the question, maybe understand that there's a different methodology. Questions about any of this? All right, statement number 3, CFI. So I'll create a 3rd tab, and I'll call it CFI. Here's what's important about CFI. 2 things, and then we'll finish for today. I want to carry forward the years, just like we did before. All right. So, first, following this format, CFI is the income statement minus the change in the balance sheet. So as I said, we had to do those first 2 statements in order to do the CFI. Second, if I give you 3 years worth of historical accounting statements, how many CFIs can you create? So if I give you 3 years of income statements and balance sheets, how many CFIs can you create? Yeah.
Probably only 2 because of the
That's right. You can only create 2 because you need the change in the balance sheet. So you'll create 3 years of TII, you would create 3 years of TFI, but you would only create 2 years of CFI. So in this example, how many years of CFI can we create? 1. We have 1 income statement, we have 2 balance sheets, but we need 2 balance sheets to create the 1 income statement. The 1 CFI statement, right? So that's the point. You'll always need an extra balance sheet. Now we can do this on a quarterly basis or an annual basis, but you always need an extra balance sheet to create that extra period for CFI, because it's change in balance sheet. And that's point number 2. It's going to be TII impact, right, operating, minus TFI, change in TFI, is each of the buckets of the CFI statement. So what we're going to do is we're going to go through that process 4 times. So what is free cash flow? Operating cash flow, free cash flow? It's going to be the no plat minus the change in the invested capital. All right? So that's the point, and that will be our first part of our CFI. The second part of our CFI will be the operating equity investment income minus the change in the equity investments. That'll be our operating cash flows. Add the two together, cash flow available to investors. Debt minus change in debt, debt cash flow. Then here's one of the other nuances. Net income is not a cash flow. Net income is not a cash flow that you actually pay to the shareholders. If you pay interest, you're actually giving the interest expense to the bondholders of the banks. But if you make net income, you don't actually pay that as a cash flow to the shareholders. So, what's the cash flow to shareholders called? Now, off the income statement.
Dividends.
That's where the dividends come in. So this is the other tricky part of CFI. When we did the TII statement, we used net income to balance TII. When we get to the cash flow, the net income is not necessarily the cash that's actually distributed, so we will replace net income with dividends on the cash flow statement in order to get the cash flow statement to work. So that's why it gets a little tricky, because there's some nuances to that statement. So here's the danger and benefits of the book. Now don't get me wrong, I like metaphors. I use a lot of metaphors to help explain things. And the book, I think, is effective by giving you a metaphor that says, for TFI, here's the balance sheet, here's the rearranged TFI balance sheet. Here's the income statement, here's the rearranged TII income statement. Then they get to statement number 3, the CFI. Here's the GAAP cash flow, here's the rearranged CFI. What's different? You cannot get to the CFI from the GAAP cash flow. See, with the previous two statements, my income statement and balance sheet get me directly to those previous two statements of TII and TFI. But the GAAP cash flow does not get you directly to the CFI. Right? So that's the problem with this metaphor in the way that they presented it, is they're just trying to say there's 3 accounting statements, there's 3 economic statements, but the third accounting statement cannot create the CFI cash flow. You have to create it from the TII and the TFI. Otherwise, it just can't be created. All right? You can approximate it, but you can't actually create it and get it to balance. So the real reason you need a GAAP cash flow statement is that there's potentially 3 items that aren't on the income statement that affect cash flow. One of them is dividends. We just talked about that. Another one is capital expenditures. Capital expenditures aren't on the income statement. We need that for cash flow. And the third item is depreciation. Now, in this simple statement, McKinsey broke out depreciation, but most companies bury depreciation in cost of goods sold. So we often have to go to the cash flow statement to figure out what the depreciation was that was put into cost of goods sold. So on this statement, it happened to be broken out, but that's why you need a cash flow statement, because you need to figure out those 3 items. All right. So just metaphor-wise, just be careful with this last metaphor, and we're going to pick up here on the next class. But we'll do the CFI. This is the trickiest one, and this is one of the reasons why it's the trickier one. It has a couple more rules that are different for it. So here's what I'm going to do. I'm going to post a very simple example, if you guys want to do your own little practice with a solution tonight. It's not due, it's not a homework assignment, it's for your own benefit. But if you want to do your own little practice before Wednesday, it's there, or at least look at it. And then on Wednesday, at the end of the day, I'm going to post, as I said, a far more complicated series of income statement and balance sheets. As I said, there'll be 3 years of historical data, multiple statements, multiple new categories. That's going to be homework, whatever, that'll be due next Monday. And like I said, the following Monday is your midterm exam. So if that's part A of the midterm, same process. So what we're doing this week is coming up very quickly as a midterm exam. Okay? I'll post this on YouTube. Otherwise, have a good day. See you guys on Wednesday. Remember, guest speaker for the 12:30 section, you guys are welcome to visit that. Otherwise, this section will be talking about cash flow.